Daily Mortgage Rates Live with the Mortgage Calculator. Today, we're going to go through some live rates and then we are going to do a deep dive into mixed use properties. But before we do that, we'll wait here just a few minutes, let everybody jump on. Feel free to drop a comment there in the chat as you jump on. I see some people were already commenting. Owen, Warren, Harriet, thank you for tuning in nice and early. We'll wait to go live on all the different platforms. We are streaming on YouTube and Facebook and LinkedIn. So give us a second to go live. Keep dropping those comments in there. Adam, good morning. Thank you, everybody, for tuning in early. We'll get started here shortly. Hope everyone had a great week and is ready for a great weekend. Happy Friday to everyone. Hello, Jason, tuning in, commenting there. Thank you, everyone, for tuning in nice and early. All right, it looks like we are live on all the different platforms, so we can go ahead and get it started here. We'll take the chat off the screen, but feel free to keep dropping comments in the chat there. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on this show every morning is go through live rates for different programs, and then we do a deep dive into a different loan topic. Now, today's deep dive is something we're very familiar with here, one of our most popular requests since we do specialize in non-QM loans and investor loans, which is mixed use properties. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to do a deep dive into mixed use properties here shortly. But before we do that, let's go ahead and do what we do every morning, which is pull up the pricing tool and go ahead and look at the actual rates for some different programs here today. So Nick, let's go ahead and pull up the pricing and see what the market is looking like this morning.
All right. Let me switch my screen tool and we'll get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and APR for today. It is Friday, July 28th, just after 11 a.m. Eastern. So most of our programs have some live rates now. If you'd like a full breakdown of all the costs that go into the APR, itemized loan estimate, please get with one of our team members. We have over 300 licensed loan officers in 24 states for primary and second homes, and we can do our DSCR business purpose, which is one of our topics for today, our mixed use property loans in 44 different states. So for all of our demos today, we will set up a nice easy scenario so we can compare APRs across the programs. We'll set the loan amount to $400,000. We'll set the LTV to 80% loan to value, 20% down payment. We will set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point to cost, which is our typical request. We're going to check out our different loan options. First, we'll check out our conforming conventional options this morning. Then we'll go into our FHA programs as we do every day. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. We also have VA and USDA. Remember, VA is only for our eligible active service members and vets. If you are eligible, we can quote that up no problem in a couple clicks. Just let us know. And same with USDA. If you do happen to be shopping in a rural USDA eligible area, the property has to be USDA eligible, then let us know and we can quote that in a few clicks, no problem. We'll start today, though, with our conforming conventional as we do every day. We'll do a purchase, 30-year fixed loan, primary occupancy, single-family home, 1 unit, state of Florida, county Miami-Dade. And for all the demos, we use an estimated FICO score of 760 and an estimated debt-to-income ratio of 40. So with the basic settings as we do every morning, let's check out the rates. So a little bit higher than it was yesterday. Obviously, some movement up and down this week. 7.125 rate for one discount point cost. Final APR of 7.292. Yesterday it was 7.1 something. So just a little movement there. Now, if for any reason our customer doesn't qualify for a conventional Fannie Mae or Freddie Mac program, typically the next option we always look at put up the same scenario, is an FHA program. So we'll keep everything else exactly the same. That way we can compare APRs across the programs. So with the same settings, let's check out the FHA options this morning. So FHA, again, it usually tracks with the conventional here. So pretty much the same story, 6.5 rate, 0.875 discount points and costs, puts our final APR just a touch above 7.088. So in this example, if our customer qualifies for both conforming, conventional, or an FHA program, FHA might be a touch cheaper in this example because the APR is slightly lower. So our customers that qualify for both, definitely check out both. And our customers that must use FHA, the recent changes have worked out in our favor, where FHA is usually pretty cheap for our customers that must use it for the higher debt to income or credit issues. Now, where we really love to help here at the Mortgage Calculator is if our customer can't qualify for any reason for either FHA or conventional. Many other banks or lenders don't have other options, but that's where we specialize with our non-QM options, where we have over 5,000 alternative loan programs where we can use alternative income. So when we select expanded guidelines, we'll keep everything else the same, but now we have a new option for income. So full doc is what we use for FHA and conventional. That is 2 years of tax returns. So typically we'll choose a non-QM option to take advantage of one of these other income options, such as asset-related programs, business bank statement programs, our investor DSCR programs for investment properties we'll talk about in a minute. Our most popular is our personal bank statement 12 months. That's what we will use for our demo here. We also have RSU, stated VOE, 1099, P&L, and CDFI, no ratio, no income. So for today, as we do every day, we'll use personal bank statement 12 month for our selection. And that's for our self-employed borrowers. Many times our self-employed borrowers with 2 years of tax returns will have different write-offs and maybe have issues where they don't qualify at all, or maybe just don't qualify for as much income as they really want to get the home they really want. So in this case, instead of using tax returns, no tax returns involved at all, we're simply going to use their last 12 bank statements to determine a debt to income ratio of 40% in this example, using their cash in the bank, no tax returns involved at all, and therefore our self-employed borrowers usually qualify for double, triple, quadruple the income and can really get that home of their dreams. So these non-QM options are typically a little bit more expensive, but let's check out these solutions for our borrowers who would otherwise be stuck. So here's our best option at the top, 7.25 rate using bank statements for 2.5 discount points and costs, a little more expensive, but notice our final APR at 7.367. So when the non-QM options are very comparable with conventional, we love this. These are our specialty. So here we have a bank statement option that actually is almost identical to conventional today, just because conventional reacts typically a more knee-jerk reaction to the rates than the non-QM options do. So we have a bunch of different options. These programs are all unique. So you see there's hundreds of different options here. Some of these may allow things like credit events, like foreclosures and bankruptcies that would otherwise make us not be able to qualify for the standard programs. So please get with our team. They will find the best one for you that obviously can use bank statements, but also may solve some other issues as well. Now, before we get into Jose's example, we always do our live rates for investment properties. So we'll do our final 2 live rates for investment property here on the occupancy. We'll do the same exact scenario as we did for everything else, 80% loan to value, 20% down payment. And we're going to compare our investment property options, which is just going to be our conventional options and our non-QM options. Remember, the government programs, FHA, VA, USDA, do not work for investments, so we'll simply compare these two. So everything else will stay exactly the same. The only thing we've edited here is the occupancy. So we will see what adjustments the conventional programs have added for investment properties. So the best option right now, 7.5 rate, 3.75 discount points and costs, puts our final APR at 7.758 here for our investment property on the conventional programs. So our customers that qualify for this is a good option. However, many of our investors that are looking for investment properties would rather have a lower cost option, Unfortunately, with conventional, with the adjustments they have for investment properties, it's pretty hefty here. In this example, $15,000 is the cost to our investor in this scenario. Most investors would rather have a slightly higher rate in order to reduce those discount points. Unfortunately, with conventional, there aren't a lot of options here to go up in rate. Therefore, that's where we love to present our non-QM options for our investors. So for the final demo here, we'll set up the same scenario, investment property, ADLTV, with our expanded guidelines non-QM options. Now for an investment property, first we select our income verification. The most popular option by far is our DSCR option. That's because it doesn't require any income or employment from our investor, our borrower. We simply use the estimated rental income from the property we're purchasing in this example to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage we're proposing, that is a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. If the property does not quite cash flow, that's a ratio under 1.00, and we still have options for that as well. For the demo, as we do every time though, we always put 1.5, that's the max. That way we can see all the options pop up. And the final thing we must select is a prepayment penalty. 3 years is standard for a non-QM investment property. We have options for no prepayment penalty that will limit the loan programs and cost more. And there are options for 5 years as well, which will limit the loan programs, but save some money for our investors. So the most common is 3 years, so that's what we use for our demo here. So with these basic settings, let's check the DSCR options this morning. So best option at the top here, 8.125 rate for 0.725 discount points and costs. So we solved that problem for our investor here. And the final APR is 8.182, so very comparable. Remember, conventional is at about 7.75 today, and we have a DSCR option at 8.182, so not even a half a point higher there on the APR, the final APR, comparing a DSCR to a conventional program. And of course, our investor would have had to spend $15,000 out of pocket for the conventional option, and now only $2,900, so a big difference for our investor here. They are happy. Most investors that see a conventional quote side by side with a DSCR quote will typically choose the DSCR option for not only the flexibility, but there are other things we can do with these, such as bankruptcy and foreclosures, as I mentioned before, credit issues. And also we can use in some of these other programs, maybe a little bit higher rate, short-term rental income, which is a very popular request. And now we will go into Jose's deep dive example, which is a special version of this DSCR for a very unique type of property, which will be our mixed use property loans. So a mixed use property is obviously going to have mixed usage components. What we're talking about and what we're focusing on here is a mixed use property that is primarily residential. So you look in the little picture here, kind of a good example. These are the new types of developments that are very popular. Mixed usage is typically the highest and best usage of property zoning in most cities that are more progressive. So very popular zoning. So very popular for new construction. Also very popular for investors that can get a commercial portion usually down below and usually a residential portion above is the typical mix, just like in the picture here. So if you think of something with a few apartments above it, just like the picture here, and some retail space or some other type of space below it, is what we're focusing on here. Obviously, there's a ton of variations within a mixed use property, but I think we definitely want to focus on the ones that are most common here for us, which are going to be primarily residential. Once you go primarily commercial, that's basically a full commercial property. So that's not the kind of loophole that we're referring to here. So, Jose, if you're ready, why don't you introduce your quote options and we'll check them out. I think you're still muted there.
All right. Good morning, everybody. This is definitely one of my favorite products to present because this is one where we definitely always hit it out of the park, right? We have amazing mixed use products, especially the mixed use product that is at least 50% residential, and the other 50% obviously would be commercial. Uh, if it is less than 50% residential, we do have an option for that, which is going to be the last quote example that I'm going to give, and that's where you're going to be able to really compare the and put in context how amazing the rate is on this very special niche program that we have, right? Like I was mentioning, uh, this is for from 2 to 8 units, where at least 50% of the space is residential. The other 50% is commercial. Could be professional office, could be retail, maybe a convenience store. What they don't want is that the commercial component be like industrial or manufacturing or anything like that. So, and usually what you're going to find in the mixed use options is you're going to find the second floor is going to be the residential component, and then the first floor is usually going to have some type of a retail or professional office component. It looks nice and neat. Usually, also for the mixed use product, they do require that the property be 2 stories, right? Because they want some type of separation between the residential component and the commercial component. So I'm going to share with you some purchase options today. So let's get uh, here in our first option. Now, I will make a note that the maximum loan to value is 75% on this product, right? There is not an 80% option here that we're offering today. Uh, so here with a 760 plus credit score is your best options, the best pricing. Um, so 9.25 actually has a little bit of a lender credit. Let me make that a little bit bigger for you all. Okay. So 9.25 does have a little bit of a lender credit, and you can buy it all the way down to 8.25. Now, what I will state is that most of the other mixed use products that I have seen out there that are also for the residential component, um, like I'm presenting right now, do have interest rates like 2.5% higher than this one. So that's why I say this is a really great niche that we have for this property type. So now with a 740 to a 759 credit score, the rate increases by 0.125 of 1%, but you can still obtain 75% loan to value on your purchase. 740 to 759. Now we have 720 to 739. Again, you can still obtain 75% loan to value on your purchase. Only difference is that the rate increases by another 0.125, and the pricing does increase a little bit because, okay, we actually do have a little bit of a lender credit. Actually, I had to scroll down far enough, but let's look at that difference here in the pricing a minute. This one was 9.375. So the rate does increase by 1/4%, but you can see that at that rate you have more of a lender credit. The other option had $141 lender credit. This one has $844 lender credit, and you can buy it down all the way to 8.5%. Now, here's where it changes a little bit in terms of the loan to value. Once you drop below 720, that's the pivotal number here, below 720. Now your LTV does drop. In this case, 700 to 719 on a purchase is a maximum 70% loan to value. Now the rate does drop a little bit uh, From the other option I just showed you here, you have 9.5% with $131 lender credit, and 8.375% is your lowest rate option. So now they do drop the LTV on you, but they also drop the rates a little bit. So now we have 680 to 699 credit score. You will note again that the LTV does drop by another 5%. So here, the rate 9.375. Rate is still good. They're not hitting you with a double whammy there. So they do drop the LTV, but the rate still stays good. Actually, looks to possibly be a little bit better. It was 9.5 at a 70, but here at the 65, it's 9.375 is your lowest cost option, and 8.25 your lowest rate option. Again, 680 credit score, 65% LTV. We're using our example 750 purchase, so 487 500 loan amounts. So now we have 660 credit score, right? We maintain the same loan amount, but they do increase the rate. So now we have 10.125 with your lowest cost option there. And you can buy it down to 7%, 9%. Wish it was 7%. You can buy it down to 9% as your lowest rate option, but most importantly, still 65% LTV. So now, as our last option here, okay, we increase our credit back to 800. We increase our LTV to 75%. But now this is for a mixed use property that does not meet the 50% or greater residential component. It could be.
So this is basically commercial.
Yeah, this would be our true commercial option. It could have still a residential component, but this would be like for your mixed use property that's all commercial as well, where all your units are commercial in nature, but you have different uses within the building or the structure or whatever it is that your six units or five or however units you have. So this is mixed use. 11.99, and this is a not a lender paid option. So in that pricing, there would have to be additional charge to the borrower. So there are no points to buy down at this rate, but there is the borrower paid comp that would have to be taken into consideration. Whereas the other options that I was showing are lender paid comp options, where the points are just to buy down the rate, but whatever compensation is paid is already included in the loan. This one is not that way, so take that into consideration. So still good option for your mixed use, which is a higher risk product, but you can see the difference between one and the other. And the other option that I didn't show today because they just weren't competitive for the residential type mixed use product, the rates are basically lender paid options, but similar to this rate that you're seeing here, much higher than the rates that I was offering.
All right, looks like we got a couple of questions here. If you want to put one of those up, Nick. So can anyone comment on where in the country these DSCR loans cash flow? And I imagine you're asking DSCR loans in general too. You want to touch on that, Jose?
I mean, we close
deals every day
all over the country. So I would tell you that, yes, sometimes you may have a situation where it may not cash flow. Like for this particular product, the minimum DSCR is 1.1, right? So typically on a 2 to 8 unit, especially as you go up in the units, you're going to have a good cash flow. So I would tell you that more often than not, we do not have any issues because the rents are very high. Rents are very high and keep climbing. That's why these investors are so motivated. That's why they don't have as much difficulty digesting these higher rates and just buying compared to the primary occupant that is looking at the higher rates and is looking at it from a different perspective, right? The investor's looking at their bottom line and they are making a net gain on their monthly rent. If it DSCRs, it above 1.0, they're making money on the property.
I would also say, a lot of the more, I guess, smaller cities, rural states tend to cash flow a lot too, and the purchase price is lower, but rents are still high, right, Jose? There's certain parts of
Yeah.
the country,
Oh, yeah. I mean, I'm
where
not. I'm not gonna. I mean, I would say Ohio. We find opportunities like what Kyle just mentioned, Pennsylvania, and a few of the. I mean, they're going above 1.0 in most of the states, but obviously some states have lower prices than others, and the rents still maintain fairly strong. Wisconsin. I mean, I have done them in Wisconsin where the property has like a 2.0 DSCR. Their person's purchasing 100,000, 110, 120,000 on a duplex that's rented for $1,100 per side. That's $2,200 on on $110,000, $120,000 purchase that you're not financing 100%. Let's say on a standard DSCR where you're financing 80%, you're not going to be paying anywhere near that amount. So you're at like 1.8, 1.9 DSCR. So the investors are out there. We deal nationally and we get investors. That's why we tell our team, you may be calling somebody that is in South Carolina with a South Carolina phone number, but that doesn't mean that's where they're buying. They're buying all over the country because the investors are very keen on looking for all of these high cash flow opportunities, and they're always reaching out to us to make it happen.
And keep in mind, we also do have our interest only. I mean, you can do a 40-year interest only when you talk about cash flow. And if there's something that's not meeting the DSCR, you switch to 40-year interest only, and the cash is, coming in, the DSCR rate is no problem to hit, right? So even if you're having troubles hitting that DSCR, we also have solutions for that as well, as far as if it's going to cash flow or not. So Nick, you want to pull up the other question here from Joe? We can pull that up. Joe is asking, do these scenarios include new construction, or are there different or better ways to go about new construction?
Well, I'm not exactly sure what he means by new construction, if he means a construction loan or if he just means a newly constructed property. Okay, so construction loans, that's has nothing to do with DSCR. Construction loans are vetted by the profit margin in the deal, the cost to build, the ARV, once they're done, what it's worth, and if there's enough equity there and you have experience, the construction loan will be approved. Or no experience even, but a very good deal depending on the option. But the DSCR loan is based on the cash flow or projected cash flow of the property. So if it's a brand new property, never been rented before, that's okay. When the appraiser completes their appraisal, the 1007 on the investment properties, which is the market rent schedule addendum, is always included on these transactions, and that will state the market rent. They're going to grab usually 3 comparable rentals, or depending on the type of property, there may be more because of all the different units. And then whatever that figure is the figure that will be used. You do not need, when it's a purchase especially, you do not need to have any leases in place or anything like that. They'll do all the research for you, put it on the report, and that's what the underwriter will go by.
All right. I don't see any other questions. If you need help navigating these programs, Visit us at themortgagecalculator.com. We can pair you up with one of our 350 loan officer consultants across the country. Now, we do this show every single weekday morning at 11 a.m. Eastern time, where we go through the different rates and then do a deep dive into a different topic. So we appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all on Monday, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everybody have a great weekend.
Thanks, everybody.
Have a great day.